The current live price for Norwegian Cruise Line Holdings Ltd., New York Stock Exchange, NCLH, is $19.07 USD, reflecting an impressive surge of plus 4.55% in today's intraday trading session. Now, that massive daily pop, swinging the stock up over 4.5%, is the immediate reality confronting investors who are still reeling from a sharp post-earnings sell-off just a few days ago. The common expectation right now, especially after NCLH's stock price had fallen off a cliff, we're talking about a move of well over 15% immediately following their Q3 report, is that the volatility is still far too high, the stock is damaged, and the debt burden is simply too big of a headwind to consider a long-term position without extreme caution. The surface-level narrative is that record revenue, which they absolutely achieved at $2.94 billion, wasn't enough to offset a slight revenue miss against Wall Street's lofty expectations, leading to a panic-driven repricing. The market essentially said, record performance is nice, but if you don't grow exactly how we modeled, we will punish you. But here's the unexpected insight, the reality that starts to exceed this immediate fear. The company's management made a massive, highly confident insider purchase in the immediate aftermath of that drop. And this isn't a small-time buy. The president and CEO, Harry Sommer, along with other top executives, substantially added to their holdings. This isn't just a handful of shares. It's a confident, six-figure bet by the people who know the company's forward-looking book of business better than anyone on Wall Street. This insider buying immediately introduces a tension between the recent price action and the conviction of the company's leadership, creating a powerful curiosity loop that demands a deeper look beyond the fear of the last week's stock crash. The prevailing belief across the market is straightforward. The cruise line sector, including Norwegian Cruise Line Holdings Ltd., is in a structural rebound, buoyed by seemingly insatiable pent-up demand for experiential travel. The general consensus is that bookings are strong, ships are sailing full, NCLH's load factor was an impressive 106.4% in the third quarter, and the worst of the pandemic-era balance sheet wreckage is behind them. But the contrarian take, the deeper reality that the market is struggling to process, is that this entire optimism is predicated on two things: sustained consumer strength and NCLH's ability to reduce its crushing debt load, currently sitting around $14.5 billion. The recent sell-off, despite an adjusted earnings per share beat of $1.20 against a $1.14 guide, was triggered by a couple of very specific points that highlight this tension: the marginal revenue miss and management's own observation about family bookings. They noted that a higher mix of family bookings, while great for occupancy, can slightly hurt the pricing mix, which translates into lower net yields than the market has come to expect from this high-demand environment. Investors were hoping for premium pricing power to accelerate margin recovery, and the suggestion that their high occupancy is coming at a slight cost to yield is what caused the immediate emotional market reaction. It was a signal that the recovery might be strong, but it's not without friction, and that friction is being felt in the stock's valuation, especially when compared to rivals. This is where the self-investing individual brokerage investor, perhaps managing their assets through platforms like Fidelity or a simpler interface like Robinhood, needs to pause and move beyond the headlines. The story is in the detail of that guidance. Let's unpack the recent stop movement, as it's the core of the Norwegian Cruise Line Holdings Ltd. narrative right now. The stock had already been under pressure, and the earnings report simply acted as a catalyst for a steep technical breakdown. We saw massive trading volumes as institutional money, which is always highly sensitive to forward-looking statements and subtle shifts in guidance, aggressively sold off shares. This institutional activity created a huge volume-driven descent, driving the stock from well above the $22 mark down towards the $18 support level. This is not simply a reaction to a single quarter's numbers. It's a reevaluation of the company's speed of deleveraging and their path to restoring pre-pandemic margins in a high interest rate environment. The market is looking at a high debt-to-equity ratio of nearly 8.8 and asking tough questions about financial flexibility, especially with macroeconomic pressures potentially slowing the consumer discretionary spending train. The fact that NCLH's CEO, Mr. Sommer, stepped in and bought a significant block of shares suggests he believes the market has overreacted to the negative optics, viewing the stock at its current levels as deeply undervalued based on its underlying operational momentum. This leads directly to today's rebound, a combination of short sellers taking profit after the steep fall and sophisticated investors likely tracking the insider purchasing, seeing the stock near a 52-week low and establishing an entry position, a classic buy the dip scenario driven by high conviction from the inside. This price action, from a 15% drop to a 4.5% daily surge, highlights extreme volatility, which is a common characteristic of highly leveraged stocks in a cyclical recovery. And it's a key point that any user of a service like Interactive Brokers or SoFi Invest, who relies on robust trading tools and data, needs to be aware of. To truly understand Norwegian Cruise Line Holdings Ltd. as an investment, you have to step back from the daily swings and grasp its core business structure. The company operates a global fleet of 34 ships under 3 distinct brands: Norwegian Cruise Line, which is the contemporary mass-market brand, Oceania Cruises, which sits in the upper premium category, and Regent Seven Seas Cruises, which defines the ultra-luxury segment. This multi-brand strategy is crucial because it allows them to target a very wide spectrum of the consumer discretionary market, from families looking for value on a short Caribbean trip, the demographic that slightly tempered yields this quarter, to high net worth individuals who are less sensitive to inflation and macroeconomic pressures, booking those high-margin, long-haul luxury cruises. This segmentation provides a level of operational resiliency that a single brand operator might lack. The operational machine is built on high capacity utilization and a dual revenue stream: ticket sales, gross capacity days, and high margin onboard spend, net yield, such as bar sales, excursions, and specialty dining. The past few years have been characterized by a relentless focus on bringing back capacity to 100%, improving operational efficiency, and reducing the cash burn that plagued the industry during the travel restrictions. NCLH has been aggressive in fleet modernization and expansion, with a pipeline of new ships scheduled for delivery through 2036, which is a clear signal of management's long-term conviction even as the stock price remains volatile. The company's recent strategic capital market transactions, including the reduction of shares outstanding by over 7% through buybacks tied to debt refinancing, further illustrate a commitment to improving adjusted EPS, a metric that clearly exceeded expectations this quarter, and optimizing their capital structure. This is a complex calculation that goes beyond what a casual user of online investing tools might see. It's the fine print of the financial engineering. Looking ahead, the future outlook for Norwegian Cruise Line Holdings Ltd. is a complicated knot of high demand meeting high debt. The expectation is simple: keep growing revenue, use that cash flow to pay down debt, and watch the stock re-rate higher. The reality is much more nuanced. Catalysts for a higher stock price include the successful launch of their new ships, which are more fuel efficient and revenue optimized, continued strong booking momentum, particularly into the higher yield 2026 sailings, which are already well booked, and most importantly, achieving their target net leverage ratio of around 4 times by the end of 2026. The company specifically raised its full-year adjusted EPS guidance to $2.10 and reiterated its full-year adjusted EBITDA guidance of $2.72 billion. This is the quantitative basis for the optimism. However, the risks are significant. The high beta nature of Norwegian Cruise Line Holdings Ltd. means it reacts sharply to external factors. Rising fuel costs, which have been volatile and were addressed in the Q3 report, and the persistent threat of a global economic slowdown could easily derail the consumer discretionary spending spree. Geopolitical instability is a major risk for cruise lines, as itinerary changes, like those seen in the Red Sea region, can necessitate costly repositioning and negatively impact customer perception and bookings. Furthermore, the operational challenge of integrating new capacity while maintaining cost control is a difficult one. The difference between the company's GAAP net income and their adjusted net income is substantial, partly due to one-off costs and interest expenses, which highlights the heavy financial burden they carry. The entire long-term thesis is a race between the operating margin expansion and the drag from their interest expense. Every investment decision here is a bet on the consumer and the company's ability to manage its balance sheet through a higher-for-longer interest rate environment. The market is not yet fully convinced that NCLH can execute this tightrope walk quickly enough, which explains the deep discount in the stock price